Welcome to this snippet. We're going to be talking about deferral of revenues, or basically dealing with the unearned revenue account. I'm going to make our T accounts. All right, there's this guy here. And I'm only going to do one example just because it doesn't matter what type of revenue it is. I know I did one for the prepaid expenses, but we had a couple different ones there. So let's say this one is going to be just revenue. I don't even want to name it to anything. And then this one's going to be our unearned revenue or our deferred revenue. Okay, there we go. So there's our T accounts. So let's say, and I'm going to do my journal entries over here, that on May 1st, we received $2,000 cash for work to be done in May and June, spread out equally. I'm just doing this to make it easier, okay? Because what's going to happen is on May 1st, we are going to do a recording of a journal entry. We're receiving cash as our debit. And then we're going to credit unearned revenue for $2,000. Okay. So we're going to go ahead and credit. This is a liability account, this unearned revenue. So we got to credit it by $2,000. All right, there we go. So then when we do our journal entries on May 31st, our adjusting journal entries, we're going to look at this and say, hey, did we do any work here that would necessitate us to earn this money? And the answer to that is yes. We've done half the work. We said we're basically providing the service. We're doing it all of May and June. We're basically spreading out the cost or the revenue of this equally. So we need to do an adjusting journal entry. We need to make $1,000 of this of unearned revenue, and we need to move $1,000 of this over to our revenue, just regular revenue. All right, so what we're going to do over here, hit enter there. We're going to go 1,000 here, and then we're going to come over here, and we're going to recognize $1,000 of revenue. Okay, so our journal entry can look like this. We're going to debit. Oh, I already showed us the journal entry. Sorry. What I meant to say is our balance in our unearned revenue is going to show us $1,000. And since that's a liability, it's going on our balance sheet. Revenue is a revenue account, so it's going to go on our income statement. We're going to expense that. Then in June, when we do this last bit of work, we're going to receive that $1,000 in June. And we're going to recognize it then. We won't owe any money as far as unearned revenue goes, and we'll have recognized all of those revenues. So that's recognizing revenues that you haven't earned yet. I hope that helps. Let me know if you have any questions, and we'll see you in the next one.